Good evening, everyone, and welcome. Take a breath, a deep, deep, deep breath. Now exhale. It was that kind of day on Wall Street, the kind that makes you hold your breath, the kind we haven't seen in more than 3 years. At one point today, around 1:30, the Dow was off 460 points, the steepest intraday dive since September 2011. By now, the reasons are familiar enough. Europe, where stocks from London to Athens tanked roughly 3% to nearly 7% today. Oil, it skidded again. The U.S. economy, new numbers, feeble, and to cap it all off, a fresh Ebola scare. Then something happened. The buyers, or maybe the algorithms, came back. By the end of the day, the Dow was off just 173 points, a comparatively comforting 1% drop. The Nasdaq was down a modest 11, and the S&P 15 points. Jittery investors piled into bonds. The yield on the benchmark 10-year note dipped below 2% for a while, lowest in more than a year, before moving back above that level. As for oil, domestic crude dropped below $81 a barrel early today, but ended just 6 cents lower. Still, oil posted its lowest decline since June of 2012. Brent crude tumbled to just around $84 a barrel, in the biggest one-day drop in about 4 years. Gold was up, hitting a one-month high. We have two reports about today's bungee jump in the markets. Steve Leisman on bonds and Fed policy. But first, Bob Pisani from the floor of the New York Stock Exchange.
What a day. The Dow Industrials were down 370 points at the open and down 460 points at its low before pairing most of those losses. And the turnaround was dramatic for many sectors. The Dow transports were down almost 3% in the middle of the day. It turned positive. The Russell 2000 was down about 2% in the middle of the day. It too turned positive. But there were plenty of problems throughout the day. Disappointing retail sales weighed on the retailers. High-end names like Tiffany and Coach and Nordstrom, Michael Kors were down 2 to 3% in the middle of the day. As an indication that weaker U.S. growth is an issue, just look at the transports. Truckers and railroads were down 2%. Airlines were also down 2 to 3% on Ebola concerns. That had a ripple effect through healthcare facilities. So big hospitals like Universal Health, Tenet, and LifePoint were down 4 or 5% in the middle of the day. Walmart didn't particularly help. Late in the day, it lowered its full-year sales guidance. But some investors feel that concerns about a weaker U.S. economy will pass, including Glenview's Larry Robbins, the top-performing hedge fund manager last year.
Our own checks with companies indicate that the economy is doing reasonably well in the U.S., clearly some challenges overseas, and so we don't believe that this is a change in tone in the market that's likely to be here to stay.
Oil threatening to break below $80 for the first time since 2012 again weighed on energy stocks. Big exploration and production names like Apache and Chesapeake were down 2 to 4% in the middle of the day, as were the refiners like Valero, because gasoline prices have been dropping as well. As for mergers and acquisition, the apparent demise of the $54 billion AbbVie Shire deal also weighed on the markets. Despite the problems, volume was about twice normal, and there were encouraging signs of efforts to buy when the markets were at their bottom. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
A perfect storm of bad news hitting stocks today. A second case of Ebola was diagnosed in a Texas healthcare worker who had traveled on an airliner. And U.S. economic data came in weaker than expected, raising fears that the U.S. could be coming down with the same case of economic weakness afflicting Europe.
Well, I think the market is now pricing in things. We had a fairly rich set of valuations given underlying growth prospects, and I think now the market is beginning to price in more future Fed actions, middling growth. I think this is all beginning to come together.
Retail sales actually fell 0.3% in September, worse than forecast. There were declines in auto and gasoline sales that were expected, but other weakness was broad-based, including in furniture and clothing sales, and even among internet retailers. With tremendous uncertainty over the outlook, world markets needed the American consumer to step up and spend. Instead, they stayed home. The strong downdraft in the stock market and weak economic data had a dramatic impact on interest rates. The U.S. benchmark 10-year yield at one point in the trading session fell below 2%, the lowest in 16 months. That came with a much more benign outlook for interest rate hikes from the Federal Reserve, with some now believing Fed Chair Janet Yellen may not even raise rates above the current level of 0 at all next year. Yet some economists think the American consumer is being written off too quickly. Morgan Stanley in a recent report said higher wages and better job growth have put $129 billion in consumers' pockets this holiday season that wasn't there last year. The decline in oil prices could add another $40 billion. While consumers didn't spend in September, the hope for the U.S. economy right now is that consumers take their windfall from the gas station and spend it at the mall. For Nightly Business Report, I'm Steve Leisman.